In today's session, we're going to talk about how banks create money, part two. Last time we talked about the accounting and the limits of bank money creation. Today, we're going to talk about the laws and the politics that enable this way of money creation. And just as a reminder, in our first session, we talked about how today's money system emerged from accounting, and then it evolved into a physical format in the form of coins. And then it evolved from there into a hybrid of an accounting-based system and a paper or physical-based system, where banks are the accountants of the money system and also the creators of the money system through that accounting. And what's ahead is that we're going to look at, how is it legal? How is this legal? Why did governments give banks the permission to create money? And what is the functional logic, or rather the politics of this system and how it came to be? So just as a reminder, we're looking at all of this because there are a number of scholars today who are telling us that the way money is created is intensifying economic hardships, social issues, and environmental concerns. And they're pointing to things like the way that our current bank money creation system channels money into high net worth households and corporations, and builds significant private wealth and inequality. Whereas it could be, and has been in the past, primarily been flowing into public investment, public infrastructure, schools and hospitals, and so on, and building public wealth. Or they point to this system as creating booms and busts, and whereas saying there are other ways that it could be done that would fund more significantly the real productive economy of farms and factories and so on, and produce a more stable economic situation. Or pointing to democracy and saying, look, in the current bank money system, it's the loan officers and managers of banks that are making decisions about what receives investment in the economy, and that there are other ways of doing it that are more democratic and transparent. So the goal of these videos is not to tell you what to think about it or how to think about it, but rather to help you understand how the system works, how it came to be this way, so that you can judge for yourself. And as always, see the video notes for descriptions of the large amount of scholarship that these presentations build on. So again, last time we did the accounting and limits. Today, we're going to do the law and politics. So how is it legal for banks to create money? Morgan Ricks he was the senior policy advisor for the US Treasury during the post-2008 crisis Dodd-Frank banking regulation negotiations. He's also today one of the leading banking law scholars in the country. And he puts it this way. He says, deposit banks issue special instruments called deposits that function as money. This is a legally privileged activity. Only chartered deposit banks are authorized to issue deposits, right? So I just want to hold up two parts of that, which is deposits function as money, and that this is a legally privileged activity, okay? Starting with the legally privileged activity part. In most countries, there is not a single law that gives banks the legal privilege to create money. Rather, banks' unique and exclusive privilege to create money is constructed via what some legal scholars call accommodations written into several laws. For example, there are 5 laws that govern money and banking in the United States. Each law contains elements of these legal accommodations that, taken together, turn bank-created bank deposits into the nation's money supply, right? So that's what Morgan Ricks was talking about when he's saying these deposits function as money. These accommodations create a situation in which bank deposits function as the nation's money supply. And this quote on the right is from a brief of 33 banking law scholars in a federal court that were explaining to the courts, how our banking law and money creation works. So here's just an example of one of those accommodations. I'm going to make the picture on the right bigger to make it so that you can actually try and read it in just a second. But what it provides is one of the most important legal accommodations that governments provide to banks, and that is the legal prohibition of deposit creation by all firms not licensed by the government to, quote, take deposits or, quote, receive deposits. And it's important to note that in the law, taking deposits, receiving deposits, and creating deposits, issuing deposits, these are all included in the same deposit taking definition. And so in the US, that prohibition, that exclusion against everyone else taking, receiving, creating deposits, except for commercial banks and credit unions and savings banks, is established in the United States Code 12. And so let's just take a look at that. So you can see how easy it is to even spot one of these legal accommodations. So this is Morgan Ricks underlining. He gives this slide in his presentations to just make this exact point. If you were to try and read this entire sentence, you would struggle. And so he's underlined in red the parts that make somewhat a clear logic out of it. So it shall be lawful for any person, firm, to engage to any extent whatever in the business of receiving deposits, unless incorporated under and authorized to engage and subjected to examination and regulation. In other words, it's unlawful for anybody that is not regulated to take deposits, to issue deposits, right? So if you don't have a banking license, you're not allowed to create deposits. That's what that very complex sentence is saying. The research director at the Modern Monetary Network explains it this way. Nathan Tankus says, what's confusing about this process is that no federal or state regulator will straightforwardly tell a bank that they are obtaining a license to create money. Instead, they are gaining a set of legal privileges that amount to the ability to create money. So what is Nathan talking about? These legal accommodations, these privileges that turn bank deposits into money. In most nations, the accommodations include several things that the government chooses to do. And I'm going to group these accommodations into two categories: those that precede the adoption of central banking and those that follow the adoption of central banking. And this is important because most people think that central banking and the bank money creation system, fiat money that's created by banks, is a synonymous invention with central banking. But in fact, until the 1930s, only about a dozen banks in the world, or countries in the world, had a central bank, while already most countries in the world were using this bank money creation system. And it really wasn't until the 1940s and 1950s that most of the world ended up with a central bank. Many started to implement them in the 1930s in response to the Great Depression, when they realized that it might be a good thing to have an institution that can strongly regulate the banking sector. And so new accommodations were incorporated after that time, but let's start with the ones that preceded the adoption of central banking. So the first one is that governments choose to abstain from creating money to fund their government spending. And here's what I mean by that, is that in the Constitution of the United States, just to take one country as an example, but this is quite similar in many other countries, abstentions like this. In the Constitution, it says, no state shall coin money nor emit bills of credit. Now, so what's happening here is that the federal government, the Constitution, the United States Congress, is forbidding states and subnational governments from issuing and spending money into circulation. That's something that had been possible under the Articles of Confederation, the previous federal government charter, and it was something that actually was not wanted by the billionaire class of their day. States such as Rhode Island were using the privilege to create money to pay off their debt with debt-free money, and the bondholders didn't like this, because that meant that their bonds would be paid off, and governments wouldn't need to create new bonds for them to hold and earn 6% interest on without doing any work. The second abstention is actually a bit more surprising. In the Constitution, it says Congress shall have the power to coin money and regulate the value of thereof. But while that is in the Constitution, Congress has only used that power once for the purpose of funding spending by the government, and that was to help pay for the Civil War. And so, you might think, well, wait, how can that be? The United States government has been minting coins since day one. And the answer is that actually the way that coin came into existence before the Federal Reserve Act is that the mints, the U.S. Mint operated as a public service to the citizenry. Citizens could bring, and businesses could bring silver to the mint, and the mint would convert it into coins for a fee. Right? So that's how coinage entered circulation before the Federal Reserve Act. Now, that one instance where government created money and put it in circulation for spending was during the Civil War. The government issued what were known as greenbacks. These were bills that were actually spent into circulation to pay for the war materials and soldiers and so on. And this was incredibly popular, actually. Many people wanted the government to do this because at that time, as you may remember from the last video, most of the bills that people were working with were issued by privately owned state banks, and they understood that was money that was created as debt by banks, not by the government for the purposes of spending on government services or defense. And those aside from that one issue, the government didn't start issuing bills again until after the Federal Reserve Act, when it began printing notes that were provided, again, as a service, much like the earlier mints, to banks that wanted to provide their customers with a physical representation of their electronic bank deposits. And that was discussed more in our previous video. So the second thing that governments will choose to do is, after choosing not to create money for government spending, is adopt bank deposits as the payment media that it uses to spend, tax, fine, and borrow. So if a government is not going to create its own money and spend it into circulation, what is it going to use to pay tax, spend, fine, and so on? And the answer is that it turns to the government licensed banks and it borrows money from them. And this is, the banks create the money for them in their accounting records, and then the government spends that into circulation and pays it back as bond interest, with interest as bonds. Now, this is how the Congress decided to answer the question of how it would spend and tax from day one. They established the first Bank of the United States. This is a private for-profit corporation modeled on the Bank of England, which was also a private for-profit corporation. And they borrowed money, bank deposits from the first Bank of the United States, and spent that money and taxed in that money. Just as the government of England borrowed money into existence and spent it from the Bank of England and taxed in payments to the Bank of England. And again, as far as where did the banknotes come from, it was the first Bank of the United States that was printing banknotes. They were printing them just the same way that state banks printed the banknotes that they wanted or needed to provide a physical representation of their accounting money to their depositors or their customers that wanted to make withdrawals. And so after the first Bank of the United States and the second Bank of the United States, you may know that the federal government in the United States got rid of having a central bank, a preferred bank, and it switched to banking at many different banks, such as state banks, like you can see here. As I said, most of the notes circulating in the economy until the Federal Reserve Act were issued by individual banks. So here, how did the United States government operate? Since it had abstained from creating its own money, it was borrowing money and transacting through the accounting records of state banks. It was only when the Federal Reserve Act was signed, and the Federal Reserve Act provided governments or banks with the service of printing consistently formatted banknotes, that all of these diverse banknotes created by different banks disappeared, and we ended up with a consistent currency, physical currency. But that doesn't mean that the government was creating the money and spending the money in circulation. It's the same as it was all along, which is that the banks are creating the money to provide a physical representation of their bank deposits. And now, much as the mint earlier, the government provides that service to the banks through the central bank, the Federal Reserve, at a fee. So going back to our legal accommodations, the third one is that the government then chooses to prohibit other firms that don't have banking licenses from creating deposits. And this is what makes banks special, is that no other firms are allowed to do what they do, which is create deposits. And last here, before the era of central banking, is that the governments give banks preferential access to tradable interest-earning government bonds, which carry near zero risk of default. So the reason why everybody trusts that bank deposits are going to have value is that banks have from the government received commitments from the government that they will pay the banks interest, pay the banks money in the future plus interest, and that presumably this money will make it possible for banks to always be good on their deposits. Moving now to additions that came in after central banking, governments provide to the banking sector exclusive payment clearing services for domestic and international transactions. These include those the physical media for making payments, as I mentioned already, but also things like check clearing services, international transactions across borders with other nations through their central banks, and many other services. The government also sells government-branded cash and coins to banks, as I just mentioned, so that they can provide their customers with a uniform physical representation of electronic bank deposits. And then finally, governments provide banks with deposit insurance and last resort loans, and ultimately, in many cases, bailouts that ensure that bank deposits continue to function as money and be considered to be as a reliable supply of money for the country. So what's important about understanding that banks' ability to create money is formed out of these numerous accommodations and legal and public services is to be able to see and understand that actually these accommodations are being constantly contested. Banks and regulators are battling over these accommodations in hearings and public filings and in the court of public opinion and so on. But we often don't recognize it because the battles are about technocratic minutia like capital adequacy regulations or risk buffers or collateral frameworks or financial technologies or stable coins. That may be one that you've heard about recently in the news. And in each of these cases, what the battle is really about is how much money banks will be able to create and whether or not their exclusive privilege will be sustained. And in the case of stable coins, what's happening there is that I read the trade press and the newsletters from the banking lobby in the United States and in Europe. And what they are concerned about with stable coins is that stable coins might allow financial technology companies to offer a competitor to their deposit creation. And thus, they would lose some of their exclusive privilege to be the ones creating the money supply of the country. So what's valuable about understanding that each of these contests ultimately are about how much money banks can create, who they can create it for, who else is allowed to create money, and how much they can profit also from that, is that you can understand that each of these battles presents an opportunity for groups to demand changes, big changes, but also just small changes to the system that would make a huge difference. And that's not just theoretical. You can actually see this in the way that the banking industry engages in these battles. They don't typically ask for big wholesale changes to the system. Rather, they target one little rule, one little law, statute at a time, and in that way, slowly change the entire system, typically to their advantage. Now, a banking professor at Cornell Law School, Bob Hockett, is a well-renowned expert on the banking system and has submitted multiple draft policies to Congress that have been entered in Congress with bipartisan support that would change the way bank money creation works today. Validates this idea. He says, if we target the right parts of the right regulations or statutes with very small tweaks, we can very quickly shift from speculative finance to productive finance, a full public banking platform, or both. And what he's saying there is that, if we would prefer that bank money creation be flowing into farms and factories and stabilizing the economy rather than into speculation on Wall Street and in real estate and so on, just a few small changes to laws would make that possible. Saleh Omarova is another banking legal scholar, also former nominee for the U.S. Comptroller of the Currency and former U.S. Treasury official. And she says governments are actually the most important participant in the creation of that new purchasing power by all these private banks. We as a public are subsidizing banks, so we have the right to press them all the time with respect to the decisions that they make. So again, what's valuable here about understanding the law and understanding that it's constantly being contested is that if we have concerns, and you get to decide for yourself if you do have concerns about the way the current system operates, that you have not only the right or the ability. It's not only that it can be changed, it's that you have the right to demand that it be changed. Okay, so that's my segue into the politics aspect of our talk today, because there's the law of what the law says and the institutions that it creates and what's happening as a result of that. And then there's the process of how we got to this law and what's keeping it in place.